So now let's look at how these shareholders invest in the company. Let's look at how they invest in the company. So there's what we call shares. There's what we call shares. Shares are a form of ownership. They represent the ownership of the shareholders into the company. Shares represent ownership by shareholders. Meaning if a shareholder says, I have 5 shares in the company, it means he has invested in the company. He has a stake in the company. Those are shares. That's what shares are. So when after a company is registered, there's what we call a prospectus. So for a public company, a prospectus is issued to the public. This prospectus is an invitation to the public. To invest in the company. That's the purpose of the prospectus. It's an invitation to the public to invest in the company. In other words, after a company is being registered, this is what is issued. It is issued to the public. For example, the prospectus will be stating that we are ABC Limited, and we are inviting you guys to come and buy shares. To come and buy ABC Limited shares. So the people who buy those shares are shareholders. Hence, shares represent ownership by shareholders into the company. Easy, right? So for a public company, a prospectus is issued to the public to invite the public to come and buy shares. For a private company, it's not compulsory to issue out the prospectus. So after the prospectus is being issued, people will apply for the shares. For example, let's say maybe because there's what we call authorized share capital. That's what we call authorized share capital. There's also what we call issued shares. So I said to you, the people who started the company, for example, if it was started by 2 people, meaning they might have already invested some shares, they might have some shares in the company themselves. They can also issue the prospectus to invite more people to invest into the company, because the more capital you have, the greater the chances of the company expanding. So every company has what we call the authorized share capital. This is the maximum number of shares that can be issued by the company to the public. Maximum number of shares that can be issued by the company to the public. So meaning issued shares is simply that it's shares which have been issued to the public by the company, right? Issued shares is just simple, straightforward. So for example, when a company starts, after it has been registered, the people who were responsible for registering the company, the people who were present when it was registered, those shareholders, the initial shareholders, they are the ones who decide what is the authorized share capital of the company. So they can decide whether it can be 100,000 shares. The authorized share capital can be 100,000 shares. So this means this is the maximum number of shares that can be issued to the public. That's the maximum, meaning the company cannot issue 200,000 shares, but it can issue 50,000, and then as time goes by and issue another 50,000 or another 20,000 and so on. And this figure can change. It can change as the company grows. It can change. The shareholders can decide to change it and go amend it, because it is decided when the company is being incorporated, when the company starts. Hence it is included in the memorandum of incorporation. So authorized share capital is the maximum number of shares that can be issued by the company to the public. So if a company, let's say ABC Limited as our example, has an authorized share capital of 100,000 shares, then it decides to issue 50,000 shares at 10 rands each. It issues them to the public. So let's say the prospectus stated that there are 50,000 shares which are available for issue, and then all the shares are applied for by the public. It means that those people who have applied for the shares, they are now shareholders of the company because they have bought the shares of the company. And how much are they going to buy them for? It's 10 multiplied by 50,000, which is 500,000 rands. This is how much the company is going to receive, and this is called share capital. You know from sole traders that we had a capital account. That's the amount contributed by the owner of the company into the business. And for partnerships, we also had the partnerships capital, which is the same as sole traders. But for companies, we have what you call share capital. This is also the amount which was contributed by the owners of the company, and the owners of the company are who? Shareholders. This is the amount that is contributed by the shareholders into the company. So this is the amount that the shareholders have invested into the company. This is called share capital. Amount invested by shareholders into the company. So that's how shareholders gain ownership into the company. They buy shares from the company. And they buy them for a certain amount, and that amount is what is called share capital, or you can say shareholders capital. It's still the same thing, right? Now You remember for sole traders that we had what we call drawings. For sole traders and partnership, we had what we call drawings, and this was the amount that the owners withdrew from the business, after the business has created some profit or any other time during the course of the business. This was the amount that was withdrawn by the owners of the business. But for companies, for sole traders and partnerships, the owners of the business or the partners, they had the option to withdraw the money at any time, and they no one decided for them when they were supposed to withdraw the money. But for companies, the shareholders cannot do that. They cannot just decide to withdraw what they have invested. Meaning for ABC Limited, this 500,000, the shareholder, if there were 10 shareholders, one shareholder, they cannot just decide any day and wake up and say, let me go withdraw 10,000 from what I've invested. No, it's not possible. That cannot happen. But to cater for that, in the Companies Act, there's what we call dividends. Dividends are the share of the profits of the company. Which are paid to shareholders by directors. This is very important. By directors. Paid to shareholders by directors. This is very important. And the directors have the option not to pay dividends. The directors have the option. So it's not compulsory. They have the option not to pay dividends to shareholders. Dividends are the share of their profits. So if ABC Limited made 20,000 profit in the 2020 financial year, let's say financial year end 28 Feb 2020, financial year end 2020, if ABC Limited made 20,000, directors have the option of taking some of this amount, let's say maybe 5,000, and giving it to shareholders. Now, what happens to the other 15,000? This 15,000 is retained for future expansion. It's not paid, right? So it's retained by the director. It means it remains in the company. It's retained, and it goes to what we call retained income. It's called retained income. It's not shareholders' capital, it's retained income. It is what was not paid to the shareholders by the directors. So sometimes directors do not pay dividends to shareholders for quite a number of reasons. Mostly the other reason may be because the company is not solvent. So in case it happens that the company becomes liquidated, there must be some funds available which will pay the debts due by the company. Hence I said to you at the beginning of the video that the liability of the shareholders is only limited to what they have invested in the company, right? Because they invest with the purpose. You invest to gain more. If you invest 500, you expect to gain more than 500, right? So when a company makes profit, the profit does not go to directors, it goes to the investors it goes to the people who've invested the money into the company, which are the shareholders. But now the directors, since they run the business, they know whether the business might need some cash flow injection. They do not distribute all the 20,000 to the shareholders. They distribute part of it, like 5,000. And usually the dividends, this what they distribute is called dividends. Usually the dividends are paid to shareholders twice a year. They are paid to shareholders twice a year. These dividends, they're paid twice a year, 2 times. The first time they might be paid, the first time when they are paid, they are called interim dividends. They are paid during the year. These ones, they are paid during the year. And then there's what we call final dividend. It's paid at the end of the year. End of the year. So they are usually paid 2 times a year. But remember, the directors have the option of not paying those dividends if they see that the business does not have enough cash, or if they want to retain the money for future expansion, right? So that's all about companies. That those are the most important stuff that you need to know. The other thing is that since I told you that a company is regarded as a person in the eyes of the law, this means that companies are liable to pay tax. They are liable to pay tax. They must pay tax, income tax. So in our financial statements, in the income statement, we'll be seeing tax expense and income tax expense, because as an individual, if you are earning a salary, you pay tax, right? Income tax. So companies also pay tax after they've made profit. The tax is charged from the profit amount that the company has created. So that's all about companies, guys. I'll see you on another video.